I'm Philip Bloomberg. Our company is Bloomberg Capital Partners. We are a real estate investment manager, active in real estate investments since 1990. We're a vertically integrated organization, which means we manage, lease, run our properties, conduct research, and we're a discretionary investor, which means that we run our investments not in an advisory fashion, but fully decision-making. And that means we're responsible for the outcomes. So during that time frame, we've been active not only in equity investments, but also in mezzanine debt. Fortunately, we have disengaged our mezzanine debt investments prior to the last upheaval. I can't say that's fully because our research forecast it, but to some degree, having a lot of investments in South Florida, we could see some of the forward ripple effects of overbuilding and began a retrenchment early. Maybe that's because the canary was South Florida, so-called in the mine, and we began early to see what could happen as the overbuilding occurred. But we're fortunate that our equity investments in primarily office buildings have done extraordinarily well over the last 20 years, and I think a lot of that has to do with the vertical integration, as well as a platform that is value enhancement, meaning we don't look at empty warehouses and try to envision them as Class A office buildings, which some have done and with a great deal of success. We also don't buy core, meaning we're not coupon clippers. We look at well-located office buildings and try to reposition from B to A, and we do it with our own staff. Our investors are primarily institutional investors, pension funds, foundations. In our mezz debt funds, a lot of banks, high net worth individuals. Primarily, our investor groups have been U.S. institutions. We're diversifying that to institutions, smaller institutions and high net worth investors abroad now. We're looking at a far larger and more diversified investor base because from our perspective, it provides not only a larger base to collect investors from, but also one that's a little more impervious to the changes in the economic markets. Our investment history has been defined by cycles. We like to buy low and sell high. And although that sounds like common sense, as you well know, there are a lot of institutions out there that like to buy high and sell low. And to us, that doesn't make a lot of sense. When San Francisco's hot is not when you want to buy. When it's the highest priced market in the country is not the best time to buy there. And when it starts to look bad is not the best time to sell there. So for our view of the market right now is that in the next 6 to 8 months, office building investment will start to get better. And that indeed, as was just said, there'll be opportunistic investment in distressed debt, but that it's not there yet. So a bit more waiting is probably the best thing from our perspective in the investment markets. We also think that with regard to residential, in markets like South Florida and other markets, we still see projects under construction. We see more inventory being delivered, and the pain that will be felt is not fully felt yet. And that banks haven't yet fully discounted many of the loans out there to where they will need to be discounted in order to see the kinds of opportunities that I think will be attractive to us. Frankly, it's in turbulent markets that opportunities arise, and this is a turbulent market. So from our perspective, this is a market that conferences like this and investors, if you all are in the investor mode, are most appropriate. Lastly, for our company, we are looking at opportunities to develop office buildings abroad. We're looking in Brazil, in the Emirates, and in the Far East. And I'll be happy to talk further about that a little bit later. Thank you all.
My name is Roland Siegel with GE Asset Management. Can you hear me now? Much better, okay. My name is Roland Siegel with GE Asset Management. GE Asset Management is the money management arm of GE Company. It is not GE Real Estate, which was formerly GE Capital. We're the money management arm of GE Company, and the money we manage is the pension trust of GE, as well as the money of other institutional clients. We've been equity investors for the better part of 30 years. and have invested primarily domestically across all of the normal property types and across the spectrum of risk, core, value add, and opportunistic. We're based in Stamford, Connecticut, and have approximately 25 employees. In terms of what we're looking at now, this is going to be this is fundamentally an interesting year, and I'd like to, I'd like to square it up in everybody's minds as, there probably never has been a wider dichotomy between the fundamentals of the properties and the capital markets. The capital markets are pretty tough, whether or not it's on the transaction side, volume is way down, and debt isn't very easy to get to. However, in terms of the fundamentals, by the way, I'm getting some feedback here. You guys hear me okay?
Yeah, they're trying to fix it over there. Okay. Bring it a little bit closer.
The fundamentals are largely intact across most of the property types, with the exception of real estate. And, I'd say the problem, obviously, is, the for sale product. But we're entering this cycle where there is some upheaval at a time where vacancies are pretty much in check. Certainly there are instances where vacancies have shot up, and there's been some speculative building, suburbs of Phoenix come to mind. But by and large, we're entering this cycle at a time where the fundamentals are intact, vacancies are not a problem. So as we formulate our strategy for 08 and implement it, what we're looking at is something to take advantage of the market situation 2, 3, 4 years out. So we have an appetite for development now. We believe that the cost to put up an office building will get more expensive. Office building, industrial, all of that will become more expensive, and there'll be a general lack of supply 3, 4 years out. So we view this as an opportunity. In terms of the capital markets, even we are having problems borrowing efficiently. So what we're attempting to do there is use the GE Pension Trust balance sheet, which is which has the backing of GE Company, as a method to either credit enhance deals to finance them more efficiently, or even go so far as guaranteeing the debt. Related to that, use of the balance sheet would be an interest we have on the development side of doing projects on a pre-sale basis. Property types that we're focused on are office and industrial. We're a little bearish on retail and residential at the moment. And that's it.